Yeah, this is our introduction to syndications and hedge funds, and I'll get a little bit more into the difference between the two. And for you guys down in Harrisonburg, thanks for the invite, and I sure appreciate it. Chase, you and I met when we were up at the Shenandoah Valley group, and I sure enjoyed being there as well. And so it's an exciting topic and one that I like talking about. There's my contact information up on the front, and I'll make it available at the end as well. And there's my contact information. I'll make it available later on, and then you can also get in touch through Chase. But really appreciate you having me on. And we'll start off just giving introductions about me and then introductions from each other. This is the same format that we went through, Chase, if you'll recall, a little bit over a year ago, to where everybody can start to network and just know who does what and what capabilities are there, so that folks don't get lost in a crowd. And this is also something that you can apply forward when you go to any networking group, just to know who does what role they fill. And then we'll talk a little bit about syndications versus a hedge fund and what are the differences between the two. There's a couple of pieces and terms to know, and we'll just break those down in the very simplest form. What I'm going to do is keep things at more of a satellite view this evening, and we can go into the weeds a little bit. There can be a lot of weeds to this and a lot of very small details, especially when you get talking about specific deals. But we're going to just give a general knowledge for the parts and the pieces. So at the end of this, everybody can know how to take action, and they can know how to think like a syndicator and plug in and do that. So that's my end goal. And we've got a couple of related news items and trends that would be fun to discuss once we open it up to everybody. So a little bit about me. This slide is a picture of me and my family. We love doing things together, and one of the things that I'm very grateful about in real estate, and it's just a great business, is that everything that we're doing here is real estate related. This is either on our way to visit properties, at properties, enjoying life and doing things. And so it's something that I encourage folks, if they're just looking at getting into real estate, it can really be a nice opportunity for, because everywhere you go, there's real estate there. So even if you're going out for ice cream, it's a tax deductible expense, because real estate is everywhere, unless of course you're on a cruise. So how I ended up doing syndications and looking to launch the funds is that I'll bring it a little bit of a narrative on the journey that I went in getting to there. First of all, I'm not an attorney or a tax professional, so I'm not giving any legal advice or tax advice. So that disclaimer is out there, and you'll be able to consult your own professionals in what they do. I am a licensed real estate broker. I'm licensed in a few states. I did work a lot as an REO broker back in 2007, 8, 9, when the previous market turn took place. We cracked that nut to where when someone was foreclosed, we were the ones that knocked on the door. It was very humbling. It was a lot of business, but I definitely like building things more than I like cleaning up a train wreck. But somebody needed to clean up the train wreck, and so I was grateful for the opportunity. And I had deals. I had what everybody wanted. And so I would go to the real estate investor groups, just raise my hand and say, hey, I'm an REO broker, and just hand out business cards at the end of the meeting. And it was good for a while. There was a lot of correction in the marketplace. I was able to take the investor energy that was out there that wanted to provide that correction and connect everything, and that was very satisfying. But then the investors that wanted to buy all of the deals that I had, this was around 2009, 2010, I had all of the listings and the REO properties that they were after that were distressed properties where you could buy at a discount because the banks were taking that action. But then all of their money dried up. A lot of investors were working off lines of credit. If they were utilizing hard money, that hard money dried up as well. There was a lot of hard money lenders that they would go borrow at a certain amount, and then they would lend it out at a higher amount. But because they had that expertise, that was a safe bet for them. But then their credit line dried up for no reason at all, and people were stuck. And then it was, it's like being out in a sailboat in the middle of the ocean with no wind. And so what I had to do was connect private money to the opportunities that were there. And so the individuals that would want to fix and flip, they recruited people who would fix and flip with their own private money, and then as well as private lenders who maybe did not want to actually be involved in the flip, but they wanted exposure to that type of profitable scenario collateralized by real estate. They liked real estate, and then I was able to perform weddings between those two and bring those together. And so that's where we paired those deals. And then just as a natural progression, the more competency you get at anything, and maybe on this audience or, later on people researching syndication, researching real estate investment, if this gets found, then you know how to approach a syndicator, or you know how to approach those services. And we're going to talk a little bit about the services that you need. But that's what I did, into where now instead of performing a wedding between private money and a deal, now I could just have that private money come into a collective pool, and then that could be deployed in a much easier fashion. And so it's really about a preference on how people like it. And if it's good for you, it's good to know about, because if you come across a deal or an opportunity that you may not want, but you know how to recognize it would be good for somebody else, well, now you can just make a connection, and then you're right back to performing wholesale duties and finding the deal. So the deal is the straw that stirs the drink. That is the beginning and the end of everything. The rest is just business fundamentals. And so knowing how to plug those in is very important. So what I did before, these are just the slides that we went through, is I like everybody to introduce themselves. I don't know how many you have on this evening, but when you approach anyone at any networking event, introduce yourself, let others know if you're new. And what I would do when speaking on this topic before is just have a show of hands and let everybody know if they're new, if they're willing to mentor. I know I've spent a lot of time with other folks in the group, shared cups of coffee, and walked through properties, and it's always beneficial. I think I always learn something, and I always try to be able to add value, but then also let people know if you are someone who's actively out looking all the time, whether you're a realtor or a wholesaler. These are the different characters. If you go to any real estate investor organization in the country and there's a room full of 100 people, you're going to have a few of each of these. And so, somebody who's new, willing to mentor, has the deals, maybe they actually do the fix and the flips and the renovation. These are the folks that have tools in the truck. They know what sawdust smells like. There's people that like to have more of the strategy, like rezoning something, adding value. People who have a core competency to add value to a piece of real estate by whatever means. It's not just renovation. And so if you've got capital, either you're a hard money lender, or you like to joint venture on deals, or you want an equity position, maybe you've got a line of credit that you work. I know a lot of folks up and down are the ones that actually do the work, that do the flip, and value and add the value, and then they also bring their own money to the table as well. And then also just all the ancillary roles, like either a title company, a lawyer, a mortgage broker, all of those people that provide that role to help and assist. And I'm sure everybody could tell a war story about getting the wrong title company that didn't know how to handle a unique something that was going on in a transaction. And so just having all those things ahead of time and building a team is very important. One of the ones is a syndicator and an operator. And those are the ones that I want to introduce to you so that you can evaluate if it's something that you would want to do and get more in touch with. And then you're operating in that space, or if it's something you just simply like to network. It'll intrigue you. And some people say, hey, that was made for me. I like the strategy. I like the organization. I like the network. I like bringing things together. And then some people are like, hey, not a chance in the world, but I sure want to have this opportunity that I couldn't do by myself. I want to hand that off. And so, but the main thing to know is this was a natural progression. Everybody doesn't just start out and then launch their career onto that. It's something that will progress. And so as you go through it, just know how to look forward, set goals, and go to the next step.
So
we
got Bill here. He can start us off if you'd like.
Yeah.
Bill, are you able to unmute and give a little introduction?
Yeah, hey, sorry about that. I was having a little technical difficulty there for a second. But yeah, no, my name is Bill Russell, property management business down in Augusta County, serving the Stanton and Waynesboro area. I own one rental property myself, and I'm actually under contract to pick up 2 more right now. Just looking to grow my personal portfolio and learn more, and just enjoy meeting new people too.
Yeah, property manager is one that I didn't mention, but there's a special place in heaven for property managers. And, the property management is something that's like, somebody might have 1 or 2 properties that they have on their own that they own, but they might have clients that have a portfolio of 20 properties that they would really like to sell all 20 properties, or they might have 1 multifamily property. And if all you do is fix and flip, you wouldn't be able to take that down. But a property manager, if you know how to ask some very specific questions, get to know their business instead of just go, oh, property manager, they're the ones that collect the rent and fix the leaks. Don't dismiss that effort because they're very strategic and key. And then just knowing how things are key. So, yeah, thanks, Bill.
Yeah, we have owners that pass deals on between us, and that's how I'm picking up these 2 others right now. Myself is from a current client, so yeah, works out good.
Perfect example, perfect. Well, here's some definitions. If anybody else didn't have any questions?
Hey, Ray, do you do any syndications yourself?
The syndications, I'm launching a fund, and so there's the difference between the two. As far as being able to do a syndication, I chose to do a fund, which more prepares in advance and then goes to that. So I'm more.
So it's like a blind fund. So it's like a blind fund that they would invest in, and then you go out. Yeah. Okay.
Yeah, we establish criteria. Yeah.
Yeah. I've just give you a little background on myself. I have 21 doors that I rent. Don't want any more. So what I'm doing now is I'm personally investing with my wife into syndications. I think we're in 6 now, and one of them is a blind fund through Paul Moore down in Lynchburg. And so we'll see how that one. That's pretty recent, so we'll see how that works out.
Is that his self-storage mobile home park fund?
Yeah.
Yeah.
The fund that you're doing investing is kind of interesting because you would have the money in hand to go out and invest in projects or people or other syndicators. You're not kind of have your hands handcuffed to just one person or one, multifamily or storage unit complex or something like that. You can do, multiple projects, so to speak.
Right. And you're ready. The key thing about a blind pool is that as an investor, like Devin's putting money into this one. What did you say the characteristics of it were for mobile home parks?
One was mobile home parks and storage units. It was a combo type thing.
Yeah.
The
And
fund.
then, but you can put it in there where there's just like carte blanche, here's some money, go invest with it. There's restrictions and expectations, correct?
Yeah, you're pretty much trusting that they'll invest it wisely.
Yeah. And that's the key thing. It's a lot higher on trust. And then, this is a point that I like to get to. Trust is important, but trust but verify is also important. And so you want to make sure,
Right.
this is a tip for anybody that's investing in any fund or syndication is follow the flow of money. How does it go from here to the next step and then back? And then if you can't have layers of accountability at each step, you really want to, sometimes they allow participation, and then sometimes it's more completely passive. Sometimes people are looking for a partner to come in with expertise. And so there's definitely something. And, you mentioned you had all of the heartache and experience and the scar tissue that comes along with having 20 units.
Yeah.
That's of value. And so, there's a lot to be said for that. Capitalize that, exploit that experience for profit.
I find it's best to know the syndicator or the person running it is probably about 80% of it, and then 20% of what they're investing in. Because if you can trust the person who's doing the syndication, and they have a good background for being honest and trustworthy and, follow through on what they say they're going to do, 100% of the time, then you've got a good operator there that you want to invest with. And then hopefully they go out and find the right deals.
Definitely. Yeah.
All right. Hey, everybody. This is Jimmy Kersey. I'm out of Newmarket. I'm a contractor, mostly colleague of Ray's over multiple projects over the last decade or so, I guess, right, Ray? I'm pretty much the guy that swings the hammer and gets the real work done in the project, as far as the labor management, the day-to-day job, on-site type things. Pretty much been the guy that's been in between all the other pieces of the puzzle as far as the real estate deal, but haven't necessarily put together one of my own personally.
Jimmy is the vision to help me see potholes in a project. And he has a few sayings like, that's going to be a maintenance pig, or this is what I do. Trust me on this. This will be a problem 10 years from now. And so I really appreciate that, and just the ethic and the camaraderie that goes along with that. Yeah, I've really enjoyed working on projects with Jimmy. Thanks for coming on this evening and answering the invite.
Yeah, good to be here.
So we'll keep moving forward, and the main thing is, and we can always come back to this slide at the end and do a little bit more one-on-one, and if somebody wants to explore how to plug in, and I'll talk a little bit about that through the rest of the presentation. But the main thing is just to know your lane and what you do. And for example, I like multifamily. Chase, the project that you've got, I think it's fascinating. Drove by there, took a look at it, loved it. Not going to do it because it's not my lane. And I'm going to call you. I'm going to look around for them. I'm going to ask you about what to look for. But, I know houses and single family homes, and I like to do residential real estate with a commercial brain. That's my focus for right now. And so, just knowing your lane and sticking in it. Well, let's keep moving forward. Maybe we can come back to that and have a little bit more fun later on. But diving into some definitions, a syndication, the pooling of funds from numerous investors and channeling those funds into real estate projects. And I highlighted the term real estate projects because the syndication usually has a start and a stop. You'll have a project, maybe an apartment complex where you can add value or some sort of lift or increase in it, whether you get it reperforming, repair the actual structure, or both, rezone a property, and you'll do a syndication to accomplish that project. And then, like what Devin was talking about earlier, a syndication versus a hedge fund is the main thing is time and trust. With a hedge fund, the money goes into the organized effort. The money is pooled prior to identifying the property, or maybe properties are identified, but they haven't been sought out altogether. But a syndication will begin and end. For identified properties, a hedge fund is more ongoing with the property yet to be identified. And that can be specific for any niche that you have or any niche that you know about. If you know about something, then, like with Kevin with the multifamily, or the, just house after house. Just if you're a property manager, you know stuff. If you've managed properties from the actual maintenance side, you know stuff, and you're valuable. And it's another thing to do once we start progressing through things. So those are the key differences. Here are the pieces that go into it. And before, what I like to do is I like to have the metaphor of this is like a bucket. And then all of these pieces come together to form the bucket or the container where money can be put into that container from investors. And there's the first one is the executive summary. This is the story. This is the narrative about who's doing what, why it's relevant that they do it, what are they an expert in, what experience do they have, why is this important, what problem does this solve? This is the narrative. Number two is the projections. These are the numbers that support the story. You tell the story, but then you back it up with a spreadsheet that shows these are the numbers that show and demonstrate that the story works, that we accomplish the goals of the project. Now, the PPM, the private placement memorandum, this is the disclosures. If there's anything that gets anybody in trouble in real estate, is not disclosing anything and everything that you can think of. This is market trends, things in an area, industry in an area. We've even worked into, hey, we could have a pandemic. That's a disclosure that nobody probably had, until earlier this year. And so everything that can be disclosed to where you try to talk an investor out of investing. And if you can't talk them out of investing, then they're a good investor for you. But you don't want to be soft on this. You want to disclose everything that can go wrong so everybody goes in eyes wide open and there's no surprises. The operating agreement is the business constitution. If you've ever started an LLC, this is familiar to you, and it's exactly the same thing, but it spells out what gets done on a day-to-day basis, who's doing it, who's responsible for these things. And then lastly is the subscription. And this is the contract between the investor and the syndication or the fund. And so when you have those 5 things all together, that creates the container, if you will. And then I've shifted a little bit of my mindset and the metaphor. Instead of being a bucket, I like to visualize this as a vault. Money goes into a vault and it is cared for. And this is just an example of one of the things that I do in the fund that I'm launching, is that I have an attorney oversee that client trust account. And this is one of the things that if you're investing in others, like Devin on here, if you're looking at starting one, the fund requires a high level of trust. And the best way to trust somebody is to not need to. And this lends itself to that. And it's a layer of accountability to where that vault has rules and criteria to where the money can only be deployed under certain criteria. Now, I have mine that are set for the fund that I'm going to be operating. And then if you're looking to invest in other funds or start another fund, then those are some of those things that you can set in place that establish a good level of comfort and a good level of trust. And so just look for those, know about them. These are the participants. The sponsor, or it's also known as the promoter, the syndicator. This is the person that is the center puzzle piece. Sometimes they can do almost everything. Sometimes they have strategic alliances with other partners and participants and advisory committees and inputs from others that enable them to do things like that. And they tell that in their story, in their executive summary, but it's usually somebody with a strong background and experience in a certain area, in a certain type of business activity, whether it's mobile home parks, self-storage, new construction for holding as rental properties, multifamily. Pick an expertise or a niche within the real estate market or with any market. There's a lot of these that are venture capital going into technology. And so if you're, you're interested in deploying money into whatever, stick with what you know, and then find a promoter or a sponsor of a syndication or a fund that has that same type of net as well. The next one is services. This is where they can either be creative, financial, and but the creative one was something that I enjoyed spending money on more than I thought I would. I had somebody who I paid money to tell the story. This was something that I'd been thinking about, that I'd been super passionate about, and I researched it and thought about it for over a year. And then it was tough to go from this big of a story down to something that was clear and concise. That was very refreshing. The financial numbers I mentioned about the projections, this is something to where if you and spreadsheets aren't on a first name basis, you might want to pay somebody to do the financial projections, and then it also can lend credibility to your deal or to your project or to your fund. On the legal side, this is a very specialized body of law with syndication and with funds, and so it is something that can be quite costly. Deals, like I mentioned before, deals are the straw that stir the drink. You could be the source of a deal. You could participate with somebody, and this is where your wholesalers come in. This is where, if you're a promoter and you're a sponsor, you need a network of people who do that. So make sure that you let people know who you are, what you do within your skill sets, what you like, what you don't like. There's some people that love the thrill of the hunt. They love to sit on a computer. They love to drive around and look. They get out, they knock on doors, they talk to people, they find out who owns the property next door, they go to the county and research. These are the ones. If all of that is appealing to you, that's you. If all of that just makes you shudder at the thought of spending your time doing it, then network with somebody who does. The investors, a note about the personality of money is something that I like to make here, and that if you are a sponsor or a promoter of a fund or a project where you're going to do a certain activity, I'll just use fix and flip on here because a lot of people operate in that space. If you have an investor who maybe it's somebody who's, that knows you, they like you, they trust you, but they just think flips are risky. Well, they're right. And there's no way to change their mind. All money has a personality. Don't try to change the personality of the money. Just put the right money in the right spot. Mm-hmm. And then this is something that also comes into play in your capital stack. What I mean by capital stack is to do a whole deal, you might have a big chunk of it is bank financing. And that has, just super conservative personality. They don't want to take risk past a certain threshold. They've got hula hoops for you to jump through, and you decide if it's okay with doing that. But then if you can have that lower cost money, it allows the top level investors to that are putting the money in that is required by the bank to make a little bit more money. So all of that variety of input can influence one or the other things. But the main thing is just to know the personality of the money that's coming in. And this is where I always like to ask people, and if they've ever had nosy money come in where they want to pick colors or tell you what to do or not what to do. I'm sure if the audience is truthful enough, they'll let you know that, hey, there are some deals you're just ready to get done with. And just know the money that's coming in as well as the operator. Value add. This is, like I said, if you have somebody that can come in and rewrite and get something passed to change zoning, that's where no work gets done to the property, but you can multiply the value of a property just by changing the zoning or having some sort of legal structure. Now, that takes a lot of influence, and that's not as easy as it sounds, but there's a lot of different ways to add value to a property other than just taking something ugly and making it pretty. And so learn about all the different ways to do that, because they might have an opportunity for you to either become a promoter and a sponsor of a deal or work with someone who does. The exit is one that's often overlooked, but it's very important. It's kind of like flying an airplane. The landing is more important than the takeoff. You've got to be able to get out of that deal, and that's usually through a sale or a refinance or just holding long term. And if you're going to hold long term, you're going to want to know what your parameters are on a very long scale. And so just being able to exit and good strategies, being able to have multiple exits, just like if you're going to buy, renovate, and sell a house, if you're in a market that might turn and might have some hardship, if you can always hold that house as a rental property, well, now you have two exits. And so as long as you have multiple exits and you know the certainty of the exits that are there, and then those can be quantified and documented, then you're safe. And that's one way to safeguard yourself other than just what the current value of the market is. And so it'd be impossible on our Zoom meeting, but I usually like to role play and discuss the connection and the progression of things and how a deal gets put together. But, just imagine yourself through the conversation of this as, hey, I identify myself as somebody who would not want to swing a hammer, but I've got money that I'd like to invest and I'd like to have it be taken care of. Or maybe you're somebody who can participate in these other ways.
I really like your comment about knowing the investor. I think one of the shifts I've noticed in myself is when I first was into real estate, I would try to pigeonhole, I'm looking for this type of investment, where I think a big shift for me was when I started to look for opportunities and not look for like exactly this one type of thing, like a buy and hold or whatever. And I think that was a big shift for me. And I think I never thought about like connections being kind of similar to that, and that they're looking for what could work well as far as having investors. I like that.
Yeah, and an investor can be a fantastic mentor. Somebody who's a young contractor who would really like to do work and has the skills and capability, might even have a whole full-blown company, but deploying capital within that structure, that's foreign. And then if you've got somebody who's got an experience as a contractor and they've done it, now maybe they're older. They don't want to swing the hammer as much anymore. And they'd love to partner up with somebody who's got that energy. So a lot of that comes through getting to know people and working together, doing projects, touring projects. You can play a hypothetical and go through somebody else's project. That's why, these events, before we were all shut in with coronavirus, going to these events, going to properties and just walking through some things is really important, especially if you get a time to where you can do that with others who would be deploying money and gather their thoughts, because they'll tell you something that you never would have thought of, but it probably would have blindsided you. Better to get that out of the way, right out of the front.
I think another big thing too, though, that I don't know if people caught it, was to know your money. That's a huge thing too, because I think a lot of people when they're starting out, they're going to just want to get as much money as they can, and it might struggle with raising money in general. And then they're trying to convince that, like you were saying, that investor that thought flipping is risky, trying to convince them to loan on a flip anyway, and so that makes a big difference too.
Yeah. And you might do it, and there's going to be a hiccup in a flip. There's going to be a day where it's like, you didn't see that coming, but you budgeted for it. And if somebody has done a flip before and go, well, these are those unexpecteds that we planned for, it's no big deal. Other than that, it can be. And so the other thing too is who not to take money from, if they're very nosy, or if they're putting the milk money in. This is one of those things where if somebody's got a real limited amount of capital, and if things do go sideways or gets, even if everything is okay, but it becomes stressful for them, that's going to be something that might affect their whole world in a negative way, even if you're doing a benefit for them. And so you really want to be cautious and conscious about the money that the people that are behind the money, the personality of the money. Chase, these are some news and trends. This is a little bit of a progression. These are in order. And, the oldest one up here is 2012. So there are some things that have happened recently, and I'll go through them. There's some things that are not on here. But a lot of things changed when we got into crowdfunding. In 2012, Title II of that act, the Jobs Act, made it legal to crowdfund real estate. There's a couple of companies that came and went. I'm not a big fan of crowdfunding for real estate, but I do know that there's still some operators that are in that space. I think it's very cumbersome, and I think it's a little bit easier to put together a fund to where you can have it operating outside of that. With the exception of the Reg A offering, and I'll get that a few lines down. The Jobs Act of 2012, the Title III, that went into effect October 30 of 16, had the final rules allowing crowdfunding. And these rules went into effect May 16th of 16. So this is only a few years ago. There's a lot of folks, if you've got relationships that have been investing or renovating, fix and flip, doing larger deals even for several years, they may not know about these things. And so there are some current events. The Reg D turned into two new categories, the 506B, if you want to think of that as before crowdfunding, and then the 506C, which is just for crowdfunding. This allows general solicitation. That's a big deal. The way things were done before is there was a couple of friends that would get together at the country club, play golf, and they would the deal would need to be done. Everybody wrote a check, and then that's how things happen. Now, investors and operators can go outside of their sphere of influence and solicit. Now, this is something where there's some rules and regulations that go along with that. Those are for accredited investors only, and then the 506B is still for you can't include a certain number of non-accredited investors. And so just know the difference on those. Another thing from the Jobs Act was Title IV, which made for a Reg A offering. This is a mini public offering. This is up to $50 million for accredited and non-accredited. Now, this is something that is, I'd like to head in this direction, but I know well enough to not go in that direction right away, because this is something that has a lot of strict regulation and scrutiny. This is something where you basically put it out there and can crowdfund the deal and recruit money that way. It feels a lot like a public offering would be on the stock market. And it's something where you can do a lot bigger things and have a lot more influence. And it's definitely something to watch for if you want to invest in things that are a little bit more established and a little bit more proven in a track record, and you're looking to invest in a fund. You might go for one that's a Reg A fund because you know they've been reviewed. And that's another strategy for you if you're a passive investor wanting to do things. But as an operator, don't jump to that right away. Don't jump to that unless you have a long plan of building your expertise. Some of these are going to be unique to me, and they might not apply to everybody, but there are some entrepreneurial energy that was released into the atmosphere with the Farm Bill passing in December 12th of 2018, which legalized industrial hemp. Now, this is a big deal just because of all the things you can make with hemp, all of the farming applications for agricultural land. We're looking at even including this in some of the construction of the homes that we're building. And there's just been a lot going on. But that plays into connecting with the next one with the age of the average farmer being over 60. There's a lot of puzzle pieces that are at play that are time sensitive. There's going to be the largest transfer of wealth this country has ever seen within the next 20 to 30 years. And that is something that as investors, we can have influence, and we can, one, make a profit, but we can also have an influence on how that wealth gets transferred. We can protect people, we can make a profit and do things in the right way. And that's a lot of the flavor and the character of what I'm doing as far as in the impact investing space, and enabling people to invest where there's a positive impact. And it's not for everybody. And there's some people that criticize that, but I think it's definitely something to be aware of, and then choose whether you like to do it. And if you are wanting to put money into the impact investing space, or if you want to be an operator in that space, you definitely want to know about it and be aware of all the pros and cons of it.
Ray, we had a question come in. How do you get yourself registered as an accredited investor? And maybe if you have a second too, you could just talk about the differences between the two for those that don't really know.
Yeah, the main difference is, accredited, you have a certain amount of wealth that you have, and then you can, and sophistication, and you can make your own decisions. I believe it's 200,000 if, or 300,000 if married, annual income, or $1 million in net assets, but don't quote me on that. That's one of the things that the attorneys have, to where if you're qualifying, is that you fill out the questionnaires on there, and then you are an accredited investor because you have either that amount of income or those amount of assets, and then you meet those thresholds. And the whole reason behind that is to protect the general population from that might really have a struggle by making an investment that goes wrong, that might be hurt by a bad actor, and that protects the general population from that. And so it's more of a designation of sophistication and capability on your own. Now, if you're an idiot and you have $1 million, chances are you're going to meet somebody, and you're not sooner or later. But that's the main difference between the two. What
do you have to do to get yourself registered so that you can get the mailings? I'm guessing he means for like offerings.
Yeah, and there's no a registry of accredited investors where you have an accolade or you exist somewhere. This is just, you certify that you meet that criteria, and because you do, you're eligible to look at these things. Now, what you can do is start networking with private placement, like Whitney Sewell's network. Reach out. Hey, I'm an accredited investor, and I'd like to look at anything you've got when it comes up. The more conversations you have like that, then you'll be there. Another note is the Citizen VC Inc. letter. This was about advertising private placements online. Now, you can do that. You can advertise a private placement online, but you do have to have basically a challenge layer, click here that you are a accredited investor, and then you're able to look. And so if you're going to a website, like say, for example, on our website, if you wanted to look at the different offerings that we have, you would have to go through that process. Don't feel like it's any website for a fund or a syndication that is out to, get your identity. Now, don't give them any specifics or anything like that, but go ahead and answer those questions. They're not questions that are wrong in asking. And so this is where if you want to go out and research online, you can go find them and, just do the search that you are an accredited investor and you want to look at those things. And be careful broadcasting that, though, because there's just a ton of things. These are the ones where, going back to the personality, the money, and the relationships, this is where you want to have those relationships with people who will bring you deals because you want to do things in a certain way, because you have a certain preference to deploying your capital. And then that Citizen VC letter, that was in 2015, which allowed sponsors and promoters of private placements to put things out online. It's that recent that you could even do that. Everything else, these things took place at the country club and in business conference rooms and meetings and things like that, to where you met with people that you knew, and that was it. And so this is something that's exciting, and it's a good way to plug in. This was one from Chase. I left this slide up just because it's fun to see what was troubling us a year ago. This was from the Shenandoah Club, was January of 2019, and we'd have had almost a year of rain, and it shut everything down, and nobody was able to do that. I think we'd trade rain for a pandemic any day. And then
it was bad though.
and we were looking at or things had full steam on the market, and was it going to keep going, or is there more to go, or other? And I know there's a lot of people who have really worn out their crystal ball trying to guess at things, but there's some areas where things shut down and people got uneasy. But I tell you what, it's really surprised me at how it has maintained and even advanced its strength in some areas. What are things like in the Harrisonburg market for you?
Yeah, it's the seller's market is just even more so. It's been that way for a few years, but just not enough houses to buy. Low inventory and low interest rates just really make things competitive for the most part. So, yeah, things have been moving.
Yeah, I think there's going to be a little bit of that. There's an undeniable amount of hardship that's out there, and I don't quite know exactly how that's going to manifest. Back in the subprime, you were enabled to get a loan if you couldn't really afford it, and they had the adjustable rates, and then they spiked. There was a lot of factors that went into this. The pandemic is just such a different thing, and there's the government playing a role in things, which always makes things interesting to see how commercial markets change. But this very meeting taking place online is something that we never would have even had the skill set to do months ago. And so things are changing, and I think there's been a lot of opportunity, and don't know exactly what it's going to look like, but I do know that there's going to be a lot of opportunity. I think the seller's market might keep rolling. I know that, everything in real estate is local and generalized. We're here, just in the DC surrounding area, where the federal government is the largest employer, and that affects the whole area and the whole region. But if there's areas that, don't have Amazon moving into it, creating 1,000 jobs or more, then it might be difficult.
We got a question that came in. Do you think that any first-time home buyers will have pain in a year or so?
It depends on the stability of your income, really. The main thing on buying a home is you're not going to get hurt when you buy. You're going to get hurt if you have to sell. And I saw this when we managed a lot of properties through the downturn, is that if you didn't have to sell, you weren't hurt. You could buy a house for $200,000, $300,000, and it would go down by $50,000 or $100,000 in value. You lost if you had to sell. That goes back to the exit. If you have to exit, that can get pretty dicey. If you don't have to exit, if you know your job is going to be stable, if you're that first-time home buyer and you know that what you're paying in your mortgage, you can afford to rent the house. So if you bought it, even if it went down in value and you had to move out of it and rent it to somebody else, now at least you're not going to have a foreclosure.
Yeah.
That's when you work with a real estate professional to, hey, what's the worst case scenario? I like playing that. It's an actual card game and a board game, but how do you be both positive and optimistic and pessimistic and cynical at the same time?
Right.
It takes both.
I just want to add to that as well that it's different this time around. There's not an oversupply in real estate. So before there was the subprime mortgages and with the adjustable rates and everything, which most people are getting low rates right now, and they're locked in for 30 years, which is awesome. It's a huge opportunity right now. Before, if you were not able to make the interest rates that spiked, that you found yourself in a really bad position because you had to sell. But then at the same time, there's an oversupply and there's foreclosures coming onto the market. So all those factors would make the prices drop. We don't have those factors now. So yes, there could be people that will not be able to afford their payment, but it should be locked. It's a very different environment than 2008.
It's a different dashboard. Usually if you're driving the vehicle and, there's fuel, oil pressure, all the different gauges that you read, there's gauges that we don't even know exist that we need to be reading. And, there are big ripples and reactionary ripples that bounce back that we haven't even thought of yet. And so it's one of those things to where, as a first-time home buyer, if you felt like your job wasn't stable or you couldn't have multiple scenarios where this isn't bad for you, then again, it's very low interest rates. And so it's a great time. I would lean more towards, going ahead and getting something as a first-time home buyer. If you're an investor, do you keep your powder dry and wait? There's opportunity in every market, up market, down market, as long as you know where you are and which direction the arrow is pointing. And, if you're at the peak, then, which we might be, then not to be too bullish in a certain direction, and to have a plan. And so, but as far as for first-time home buyers, if you're wanting to go in as a first-time home buyer / investor, I know a lot of people like to house hack or look at those opportunities and things like that. And that's totally different than anything syndication. That's just you doing it on a personal level. Keep your powder dry. There's going to be some opportunities that are out there. You don't have to pay full-on retail right now, but definitely make sure you've got your exits squared away. This next one is an opportunity zones. They passed this, and this is I think this was a brilliant idea for the government to enable individuals who have capital gains to deploy that money that they would otherwise pay to the government. So instead of going from us as a taxpayer to the government and then the government trying to stimulate things in an area, we can just deploy money as investors into an area. And it's very similar to the 1031. 1031, if you're familiar with that, again, I'm just going to give a satellite view of things. If you buy a piece of real estate for $100,000, now the value is $200,000. If you sell it, you're going to pay capital gains tax on that $100,000 gain, the capital gain. Now, if you don't touch the money, and that money goes into a 1031 custodian, and then you identify another like-kind property, well, then you can have that go into it. And the old mantra is 1031 until you die. And you go from property to property to property. You make the cash flow off of those things. And then when you die, your basis passes on to your heirs, or however you structured that. Again, I'm obviously not an attorney, and I don't want to come across like I'm giving legal advice on that, but it defers the capital gain. Now, opportunity zones address the same capital gain, but you have to invest it into these opportunity zone designated areas to where the governors identified these, and you can look at a map across the United States of opportunity zones. There's a lot of them. And then I'm going to switch to here. That's Harrisonburg. I'm not sure if you can see that or not, but I think there's a lot of areas shaded in that people can make a lot of good money in Harrisonburg by doing opportunity zone investing. And if you're looking for, let's just Google a map or Google a search of opportunity zone map. There's two that I found, one on the HUD government website. The other one is the EIG website that helped get the legislation passed back in the day. And so here is the area. This is the region. You've got right in here is Harrisonburg, and then you see some of the other ones around there. And so when you're, now it doesn't have to be real estate. That's the other thing. You could invest in a manufacturing business, lease property in that opportunity zone, put all the investment into it. It's not just real estate like a 1031 exchange is. So there's a little bit more parameter on that. It's tough to research. There's a lot of flurry about it. And then just know to really latch on to a professional. You're not going to find a professional that's got more than 2 years experience in it, because it's only been around for a little bit over that long. So just be aware of that, but have somebody guide you along the way. And this is one of those things where if you spot a deal, if you spot an opportunity, and it's ideal for real estate, for adding value to real estate, because there's parameters where you have to acquire the asset and then add money to it. Again, this is designed to get money into distressed areas, or areas that would benefit from, that are strategic to benefit from capital deployment into those areas. And that's why the governors pick these areas. They're not 100% on distress. These are things to where if you can go in and invest in an area, that investment and that momentum will then in turn cause other improvements, then they pick areas like that as well. But those are the opportunity zone areas. Restriction in the opportunity zones that it couldn't be for the cannabis industry or the agricultural processing. And there's one that I was looking at that was just super well targeted for that. There is a piece of legislation that I believe it's in the House, and then I can share that out. I forget the number on the House bill, but there's a piece of legislation that's specifically targeting industrial hemp. They didn't want a lot of money going just into the medical cannabis and the marijuana growth in these opportunity zones, so they put a restriction on that, but they're opening that up to where it can be for industrial hemp, and that way those things can benefit that area, because that benefits agriculture all through that area if you can get a processing center. And that's one of the big lag things. Again, that's what I like. That's what I like to research. And so that's one of the spaces of interest that I operate in. And it's a niche within a niche. And so I've got background in other industries, such as the organics and that type of background, that it appeals to me. And so pick what appeals to you as well. And I'll wind things down on that, and we can open it up for a discussion. But, we had some introductions. We talked about the difference between syndication and a hedge fund. One is more project specific. One is more the project is yet to be identified, and it's on an ongoing basis instead of having an end. Talk about the pieces and terms and the 5 pieces that go into it, the participants and the role that they play. And an operator may play more than one role and receive compensation for playing more than one role. So make note of that. But they're definitely, it takes a team to put everything together. If you've got one person that's doing everything, you might want to use some caution on that one as well. So we talk about how you can think and take action, connecting the dots. Just to take a look at something for a nice long time and be able to connect those dots, either putting things with the right people or the right resources can really make some nice things happen. And there's some trends that are going to happen at a lightning speed over the next 6 months. And, just buckle your seatbelts and it'll be fun. So. Matthias, you got any other questions from folks? Do you want to open it up for some conversation?
Let's open it up.
Hey, Ray.
Yeah.
Is your fund going to be 506B or C? And then what's your minimum is going to be?
Good question. Now, the rules are clear. We can't talk about details of a particular deal,
Right.
with, having that personal conversation, but I'll tell you some of the parameters that can go into a deal, and then we can follow up and talk. They can start as a 506B, and the key difference on that is that you can have up to a certain amount of non-accredited investors. If you're going to, have that strategy of starting it out, going to the friends and family, people that maybe people are, don't meet those thresholds of being an accredited investor, they can come into your deal, and then you can draw a line and then have another round of capital raising that is the 506C, where you can go and you can generally solicit it, but that is under the restriction of not accredited only. And so
Right.
that's the difference. But you can start it as one and then transition to another. Great question.
So basically, if anybody wanted to know more information, they should contact you and set up a time to get together.
Yeah, and that's that's how to a lot of and some of the questions we're going into that is like, how do I approach syndicators and fund operators and people who would sponsor these deals, and just let them know that you're available, let them know that you want to look at these things, and it's just that it's like, hey, I want to do this, I want to have more of a passive role, or I want to see. I'll give you a good example. Is we're operating in the impact investing space, and because we're looking at building with industrial hemp, I've got a lot of folks who are like, hey, how do I do anything just to support the hemp industry? And, that's just an example. If there's something that you want to see happen in the world, go out and put your investment money to it, because when the investor community and the general population does that, well, then the government doesn't have to. I'd like to think we've got a little bit better capabilities than they do sometimes.
Right.
Yeah, it'd be interesting to see how much that changes if things do get decriminalized or whatever across the whole country. People that had a head start probably would really do well in the hemp industry.
There's going to be a lot that happens. It's phenomenal as far as like the farming community, the building community, the manufacturing space. It affects everything in such or it can affect it in such a positive way. Since the Farm Bill passed, and on a federal basis, it's been the Wild West. CBD took hold, and it was like everybody discovered oxygen. And I looked at a couple of private placements that were for CBD production, like to acquire a farm, put in the operating facility, grow the product, make a finished product. It was soup to nuts, everything. And it was kind of a frantic rush, and it was, they called it the green rush, and everybody was going in, and people would just like grow stuff and not know that they were going to be able to sell it or not. They were growing it. And then it takes a little bit of skill set. It's not just throwing seeds in the ground and then having it come up. And so there's a lot of process to it, retting, drying, harvesting, to make something that's highly marketable. And so these are just examples. Now translate that into the industrial hemp space. That's an entirely different strain of hemp to grow for different purposes. And so, we're using some for building supply, which if you grew for CBD, which is more bushy variety and not planted close together, it's going to be worthless for construction. Pretty fascinating though. As an entrepreneur, it's like somebody opened up an all-you-can-eat Las Vegas buffet and you're just walking around with a plate and a fork. It is exciting and it's fun. Use caution on what you get into. And I like making things tied to real estate because at the end of the day, you've got something. And there are some that are tied to technology. I like to have a little bit more of a conservative approach, or at least keeps things separate. There's one venture that I'm looking at that has, for putting in actual manufacturing equipment, things that could be removed that are not attached to real estate. And that would be a totally different paradigm for an investor profile. Talking about the personality of money, that would be something very different.
Like we get messages where
Hey Ray, this is Kevin. What's the smallest amount you've seen put forth for any of your deals from a particular investor?
Now for a syndication and or any type of fund, they will. Again, I can't discuss specifics of mine, but I can tell you that minimums are set, and then maximums are set as well. You want to be cautious of folks that are just going out to raise all the money that they can and don't have a very specific asking for what they want, a very specific amount. And then, it's okay to have a little bit of a big window. But to answer the question on what are the minimums, usually I see those somewhere between $10,000 to $50,000, depending on, if you're trying to raise $10 million, you don't want to do it $10,000 at a time. If you're looking to raise, a small minimum of $100,000, then, that might be productive. And so it's going to vary deal by deal. Just ask what it is. And from whatever deal that you're looking at, and know about that. And then if the minimums are too small, you might want to use a little bit of caution as well, because there might be a little bit of inexperience on an operator. That deal could better be done, with a colleague or some simple business structure. They might be a little bit new into that.
Yeah, gotcha. And then have you had people use their self-directed IRA as the vehicle for investment?
Great.
So obviously, that'd be straight cash.
Yeah, great question. And I didn't talk about this at all. I'm glad you brought that up. Money going into a syndication can be from a self-directed IRA if your custodian allows it. And then that's where you get with your custodian if they don't support non-traditional investments. And, there's a couple of custodians that out there that do allow it, do support it, do teach on it. Because their investor clients, their customer base that have their IRA held under their custodianship want it. But if you just have an IRA that maybe it was spun off from, some sort of retirement account at work, and it's just with a bank, and you go and say, hey, I want to invest in a real estate syndication, we'll say that you can't. Well, they're wrong and they're right. A custodian can restrict what you put your money into. A custodian can say that they want you to do stocks, bonds, mutual funds, things like that, that they derive a commission from selling you, and they limit you that way. Other custodians, on the other hand, they say, you can do tax liens, you can do real estate, you can do gold, all those things. The non-traditional investments are like that. Now, money can come from an individual. It can come from a trust, a business, a self-directed IRA. all those different types of inputs, but just know that the tax implications go back the same way. And so if you're going to invest money and make money and be taxed, then that's when you want to choose whether you're doing that in your IRA or any type of other structure on things like that. For example, if you're going to, do a house flip or loan money to a house flip, there's parameters to that, doing it in your IRA. So you want to know the whole process. But to answer your question, yes, money can come from an IRA.
Where would you go to look for some sort of mastermind group like you mentioned? That was intriguing to me.
Oh yeah, well, you had was it Whitney Sewell? Mm-hmm. He's got a podcast that's fantastic, and he's a machine. He just puts it out daily, and I'd go to him. And, I haven't looked at him on LinkedIn or Facebook or anything like that. Bigger Pockets is a very large online RIA. There can be a lot of noise on Bigger Pockets, but you can look for keyword searches. You can do that if anybody's talking about anything that's like syndication or anything like that, it'll alert you. That's a good website. You're reaching out to multifamily. Multifamily properties are the largest syndication scenario. And so anybody like a commercial real estate broker or agent that operates in that space is going to have to know about syndication because they are often called upon to work with a deal sponsor on the acquisition side of things like that, or the disposition as well. And then they might know good networking groups and things like that. But to put together, if you want to start one, I'd be happy to do that. I think just putting together, different folks that want to accomplish things. Sure. And raising money is a great strategy for anything. I don't care what you're doing. And this is a cliche that I have, is like the money is in the money. Real estate is just something for money to do. And you're going to need to invite money to the party. And if you can invite money to the party and recruit it via syndication or a fund or just anything similar, there's really nothing you cannot do. And so I encourage that a lot across different industries other than real estate. There's a lot of syndication done in venture capital, things like that. It's like if you have a conversation with somebody and it felt like you were on Shark Tank or something like that, follow up with those people and just ask. That was one of the things that I put my mind to this year, was to start some mastermind groups. And, I've got one or two that are going and growing. And sometimes it's just, me and another colleague that are incubating ideas and growing ideas, and then we'll bring people in, and people will come and go, just like in your meeting here. There's the familiar faces and there's people that come and go, but starting one, especially Zoom, and everybody's getting used to this now.
Yeah, it'll be interesting to see how much this plays a role going forward when we're able to do things face to face, because there's some definite advantages like you're mentioning. It's pretty easy to jump on.
The mastermind that I'm a part of is, most of the folks, I know there's a handful that are in California, and then some are in a couple of different time zones across the country. But instead of coming together, once or twice a year, every Friday. And so it's really nice. It's I think the intellectual side of business and the velocity and the speed of business and how we can share ideas it's like a time that I've never seen before. There was a topic in an industry, in a previous lifetime I used to grind up trees and make compost and sell it to nurseries and stuff. And I went to trade shows, I went to conferences and things like that. And I wanted to research something. And within about 10 minutes, I found all of the information that it would take me a solid 2 years of going around and finding. It's phenomenal. I mean, it boggles my mind how much we can do. And then also, if you go on YouTube or anything like that where you're researching things, you message people, they answer back a lot of times. That's why they put it out there. And so you can just ask them, hey, can we talk? Or are you part of any groups? The mastermind one is a key one. If you find somebody that you like that is speaking to something that really resonates with you, ask if there's any ones where you could either help or join or participate. I'll be surprised.
And also on the line of podcasts and gathering information, do you have any other podcasts you recommend or that you really like or must read books, whether it's syndication, real estate, or just business mindset? You recommend?
The podcast like with Whitney, that's a good one because you get to learn about the mentality and the mindset of a lot of different syndicators. And they're not all doing it for the same reason. They're all accomplishing a very similar task, but from a different point of view. And then that's the main one on syndication. As far as like the hemp industry, there's one that I like, the Hemp Entrepreneur, and it's very key and relevant. And they've got a pretty strong business acumen, and they have some pretty high level business conversations and things like that.
What was that one again? I'm sorry.
The Hemp Entrepreneur.
Hemp Entrepreneur. Okay.
Yeah. Most of my podcasts that I have on my iPhone are on the Apple, the ones I like. I'm sure some of the group here has Investor Carrot, the Carrot Cast. They have the real estate investor related websites and services, not so much for syndication, but just for business development. I really recommend them. And then, just good old fashioned standbys that I love, like John Maxwell and guys like that just, like taking mental vitamins to, learn and make yourself better. And what do you want to get better at? Type it in and you're going to find it online.
Awesome. Thank you.
I would say this also on since the virus broke out, I have really not been paying much attention to anything that's over a week old. It's what was relevant in January is not now. And, that's one of the things that I would put out there. If somebody's giving you business advice or real estate advice or investing advice, everything's dated. The Etch-a-Sketch was shaken in March, and now we're just rewriting it. And so just pay attention to that on the timeliness of things.
I like a lot of the things that I heard. I feel like I came in a little too late to really get the gist of what I needed. I'm glad that someone asked the question about the minimum investment. And of course, I was planning to go on to the plan website to see if I can read more, because I think that diversifying is always good, but of course, capital is very important. Making sure you're not overextended in your investment. So I was definitely liking a lot of what I was hearing, and will be seeking to find out more information of how I can get involved and diversify my portfolio.
Sure. Do you do other real estate investment? Are you in the business?
I have a couple of properties that I buy and hold. Haven't really done any flipping. Mm-hmm. That hemp thing sounded like that could be something to be a passive investor in.
Right.
There's a lot of fun things. Just use your caution and make sure that it's tied to something stable.
Yeah, and that was one of the things that attracted me to joining in, is because it sounded like this is something that happens on a regular basis, like that you all meet on a regular basis, and that you get good information, and so it's a good pool of people to bounce things off of.
Happy to have you. If you go to Facebook and you go to Harrisonburg Real Estate Investors, the group, in the event for this event, you can find the video. You can go back and rewatch it from the beginning if you want to, and you can go into past events and watch the videos that we've had since this whole pandemic happened. We've gone Facebook Live, so we don't have everything from before, but feel free to do that and join us in the next one.
And it's a great way to learn what's going on in different markets and stuff, because Harrisonburg, a little over an hour away, to drive back and forth. The same with all the investor meetings that are in, in the Northern Virginia and up in the Maryland and area. That's a lot to drive. Linda, I was going to ask you if you'd been to other investor meetings in the area.
I have not. This is my first time. I've always said that I was going to go, but I'm usually doing a lot of different activities. Wish they were all very, very lucrative, but you're always, trying to chase that next thing. So I had never actually participated in one.
Yeah, the reason I ask, and this is a comment that I make, is on most of the investor groups that you go to, there's always who's interested in what, who's new, who's got money, who's a realtor, all those different things. So you can network and meet with each other and stuff like that. I'll give props and kudos to the Harrisonburg group here, is because this is a group of individuals that are coming together to mastermind, and a lot of real estate groups are out to sell membership to what a speaker has to sell. Their training programs, I've spent some money on some training programs. There's nothing wrong with that, but this group definitely has a good core dynamic, and I really enjoyed it. I enjoyed it last week, and then I'll definitely be on here from time to time as well. I enjoy being able to get insight from about that market and talk to people in that market. And I forget who it was who asked about, networking. Now that we could, go to different groups, that's another good way to do it.
Well, what I was hoping to find from being involved in an investment group is how to grow my portfolio in a way, from an information point of view, because a lot of what I've done has been like residential, and I haven't really learned a lot about commercial, or even doing like commercial loans, like just different things that you can do in real estate. I've done traditional things, like the regular loan, and you go through and you buy the property, you stay there for a year and then go and get the next one, that sort of thing, which it takes time. I mean, it's doable, but I'm sure that there are some other things that people are experiencing at a better or an exponential rate that I could take advantage of if I knew or understood how it worked.
And a fund does that to an extent, because if you're talking about making a loan, and the commercial space or in residential, and then if you're going to go in and deploy money to make a loan into that space, this is one of the advantages of a syndication, is because there's others that are required to do the same, and through many minds being applied to a project, you can get a bit of wisdom. And so it's one of those things to where if you would like to deploy money into a project or into something real estate related, you can have that added comfort knowing that others are going in there as well. And there's not always the luxury to talk to others who invest in a deal or in a syndication. Definitely have the comfort that the risk is spread out.
Yes. Because usually, it's just you and the banker or the money, and you're trying to get the deal done. You don't have anyone else, and you find out afterwards if you did a great job or not.
Hey, Ray, Kevin again. Just wanted to see what your thoughts were on commercial real estate, as she just mentioned a moment ago, given the push to online shopping and whatnot that's been accelerated by way of COVID.
I think there's going to be a lot of opportunity. And I wish I had a better crystal ball for you other than that. I think it's too early to tell when or what is going to happen. I know my heart breaks for restaurants and just how the virus has hit them and the impact of just being closed. Most people can withstand getting punched in the gut once, but just being pounded, month after month like that, that's tough. Then also there's trends like an office building. The people who can work from home, now they're not going into the office. And then all of the retail establishments and the services along the way of a commuter route, the gas station, things like that. All of there's ripples that we don't even know that are there. But those are some of the big trends, like office space, retail for sure. But I wish I had a better crystal ball. That's why I stay in my lane with the residential and the affordable home scenario of the residential, not multifamily. I swim in that pond enough to know about it because it's what I compete with. I want to make sure that I destroy what's competing with my single family home. But as far as the commercial goes, if you're in that space, be looking for some opportunity. There's going to be there. There's going to be some there. Is there a specific segment of commercial that you were looking at, be it retail or whatnot?
No, I don't own any commercial. I just like to I like to ask that question of people because like everything you just said, I could echo. It's like, man, I think there's some major game changers out there right now, but it hasn't developed yet. And there are many ripples, like you were saying. I'm even wondering if like these office space locations in bigger cities are eventually going to have to maybe reconfigure and turn into like residential. Like maybe they turn it into apartment buildings because people are finding we don't need to have these huge offices because we can work remotely for maybe 50% of our staff now.
Yeah.
And that's what I was thinking of commercial when I said it. Sorry if I didn't specify. I was more interested in getting like that 20-unit apartment building or 100-unit apartment building.
I know it's still too early to tell for sure, but a recent real estate investor meeting on Zoom call that I was on, a guy that owns a bunch of single-family homes and multifamily properties, he was actually talking about how he was selling his multifamily properties and buying more single-family because the quarantine actually was pushing people out of the apartments and they wanted their own space and own house instead of living right next door to people. Be interesting to see if that plays out or not.
Well, if you know who that guy is, give him my number.
That's the great thing about Zoom. He was on our Waynesboro call, but he lived out in California somewhere. I can look it up for you, but he wasn't a local one. That's the great thing. You can get people from all around the country on these things.
Oh yeah. That's very well. And there's a lot of folks who were very profitable in certain market areas. Like say if you made money in Washington, D.C., or if you made money in Silicon Valley in California, you're not going to go buy affordable homes in Silicon Valley in California. You're going to go to a different marketplace. And, that takes getting on a call, getting on a plane maybe, and going there and connecting with people. So yeah.
Ray, do you see any, or could you see any people coming from Northern Virginia to Winchester to relocate to try to go to a smaller area, since they may be working remotely from now on, if companies decide that they don't need to meet in offices as much?
Yeah, Winchester has been a little bit of a bedroom community. It's got its own economic base as well, but there's a lot of commuters already, and there's a lot of demand. When in 2004, 5, and 6, it pushed everybody out. And then when there was that was just prices pushing people out. Hey, I can have just as much of a house if I live at, or more house if I live out in Winchester and commute. And then when 2007 and 8 happened, the rubber band snapped, and everybody went back. It's like, hey, why am I commuting when I can go, Purcellville, Leesburg, further back in, and have the same. And then now. There is a bit of a rush to the suburban areas, the single family areas. If you're in downtown Manhattan, you want the burbs, and there's a lot of demand going on there. And, it's kind of like water. It's going to settle out. Right. If you lived in downtown Manhattan and then you move to the burbs, you're going to want to go back. It's all in lifestyle and what you like and what you prefer. So yeah.
Hey, one of the downfalls of this movement from out of the city, say they can work from home, is say the company that you're working for says you can do that, and so I can be in Harrisonburg and maybe my company's in New York. Mm-hmm. So 2 years passes and the company's having a little bit of a downturn. They say, got to change your plans. Everybody now has to work in New York.
Yeah.
And people just quit or they get stuck. And I've seen that happen too with that. They can do that to you. And that's one of the ways they're going to do it.
Yeah, or maybe you live in New York or the metropolitan area, wherever it is, and then maybe you like where you live, the kids are all settled in, you like the neighbors, but you're working from home, and they're like, hey, you can work from home from anywhere where there's a lower cost of living. We're going to, your salary is now reduced because you don't have to live here.
Right.
And, there's just a lot of things we haven't thought of. And back to the question about, first-time home buyer or any home buyer is, make sure if you bought a home and then now you're forced to move back, if it goes from being a seller's market to a buyer's market, go back and study the patterns of when people had to do a short sale. If you can rent that property, move out of it and rent it and be positive on it, make your payments, you're much safer. You're less vulnerable than if your mortgage is more than what it would rent for. You could be stuck needing to write a check, a big one still. Saw a lot of people have that happen to them.
Yeah, I love your rule of thumb of you only lose money if you have to sell, and that's what I've been telling my clients as well. If you can have backup plans like that, it's key.
Yeah, that's the whole mentality of any wholesaling or investor group is find sellers who either through motivation you can solve a problem, or that just out of preference they would rather sell quick at a discount, and then you solve the problem and meet their need. And 9 times out of 10 or more, maybe it's 99 out of 100, you're not their best fit. But for the 1% of the time where you are their best fit, man, they're glad to have you. And then that's what us investors do. We solve those problems, and there's a place for it.
Well, does anybody have any other things they want to address or ask? If not, we've hit the 8 o'clock mark. Not that we have to end right at 8, but I want to respect Ray's time. So really, thank you for coming out.
Likewise.
coming out, being on the call, and sharing your wisdom.
Well, other than that, I'll jump off, and then don't feel like everybody has to go home, but I'm gonna go ahead and jump off here. And again, thanks for having me out.